Hello there guys, what is going on? You should trade the market short next week and I'll show you why. We had a Tuesday RDR that formed above the Wednesday ODR and that pointed us short for the entire week, and a week is from Tuesday to Tuesday, but the market doesn't go in a straight line. There are retracements throughout the way there. So where do I take my retracements? Look, if I'm going to trade against the weekly, which is short in this case, then I'm going to look at the Thursday turnaround to do that. But where does the Thursday turnaround retrace to? So there are many options here. It could retrace anywhere. This is the thing. This is why you look for setups during the week. So if we are short, then I'm looking for short confirmations, and if we are trading long, I'm looking for long confirmations. Going to continue short once the retracement is done. Let me point you to a good setup that happened on that Thursday, the turnaround. So we know the most recent move is down and the market is pointing down because of the whole Wednesday ODR thing. So what we need to identify are the DR levels, and after you have identified that, you look for the candle that now closes above the DR levels, because you are looking for a long confirmation. Why long? Because the Thursday turnaround, we're turning around, we're turning to the opposite direction of what the weekly is pointing to. Then we have a 75 to 88% probability that prices aren't going to go closing below this level here. So that's very powerful in itself. But how do you trade all of this? There are many ways. You can use standard deviations. The way you do that is identify your DR levels and your IDR levels, and then you draw a fib from the bottom to the top there, from one IDR to the next one there. If you're going long, you draw from the bottom to the top, and then you'll get these standard deviations. So how do you use these deviations? So once you get the market close, you can data driven, you can see that most of the time where prices are moving to, which standard deviation it's moving to. But if that's all too complicated, you can just use standard normal Fibonacci. After you get your confirmation, you can draw a usual Fibonacci and retrace from 50% and then go long, or 78.6, or whatever your preferred Fibonacci level is. Or you can just use your ICT sort of value gaps here. So prices closes above, so you're looking for longs, and then as soon as prices trades in the fair value gap, then you just continue going long. Or like in this case here, another fair value gap, prices comes down into the fair value gap, and then you go long. So remember, this week we are looking for shorting opportunities Monday and Tuesday. So how do we do that? So we identify all the DR levels and the IDR levels, because this is where we want to see prices then eventually retrace to. I don't know which level it's going to retrace to, but you are looking for shorting opportunities there. So you get your prices gets to the level, and then you look for a shorting opportunity, and then you just follow your setup there. Thanks for watching, guys. Don't forget to subscribe, like the video, and comment if you don't understand this. We can have a conversation about this in the comments. Thanks a lot for watching, guys. Bye bye.